Hi everyone, this is Mrs. V Chen. Welcome to my Form 4 Accounting lesson number 22. Alright, so today is 9th of July 2020 and today's topic is inventory valuation. Okay, and then I'm going to use the past exam question in 1997 to show you how do we work out inventory. Alright, okay, and here is my question in 1997. Alright, and part A here, what we need to do is to draw up a statement to compute the appropriate stock value as at 31st March 1997. Alright, so since this is the old name we used in Hong Kong, and now I'm going to change it to inventory. Alright, so here is my statement showing the value of inventory as at the date mentioned in the question. Alright, and then part 1 here, we are given the inventory as at 31st December 1996 was 52,673. So here in my statements, I start with this inventory as at 31st December 1996, and which is 52,673. All right, and I'm going to add something and then minus something from that figure, and then to work out the inventory as at 31st March 1997. Alright, so before we look at the question, it is very important we do analysis first. So here is my timeline to explain the situation for you. Now we start with the inventory given to us as at this 31st December 1996. And later on, we need to work out the inventory as at March 31st, 1997. Alright, so let us list all the things that may happen during these 3 months related to inventory. Okay, so what things may happen during these 3 months? We may have sales of inventory, and then if we start with this figure, so what happened after sales? We may have less inventory, so we minus sales. Okay, and then we may have purchases of inventory from the supplier, and if we start from this figure, after that we have more inventory, right? Okay, and then after purchases, we may not satisfy about the things purchased from supplier, so therefore we may have returns outwards to the supplier. Is that right? Okay, and after return outwards, and then we start from this figure, we have less inventory, so I minus here. Okay, and what about sales? Okay, after sales to customer, we may allow customer to have returns inwards to our firm. Is that right? Okay, so after that, after returns inwards, we may have more inventory. So therefore, this is the idea. If we start from this figure and during these 3 months, so minus sales because we have less inventory, more inventory after purchases, less inventory, okay, after return hours, and then more inventory after return inwards. So therefore, this will be the answer, equals to 31st March, the figure of inventory on 31st March 1997. All right, so this is the basic idea for that. And later on, if you look at the value of inventory, so inventory should be always valued at costs. Okay, but however, when you look at sales, sales is not valued at cost. Sales is valued at selling price. Therefore, later on, we have to change selling price back to costs, right? Agree with me? And then for purchases is already at costs, so therefore we don't need to do any adjustments. And also, return outwards being opposite to purchases, so it is also already at costs. Okay, and finally, now we come to return inwards, which is opposite to sales, so this is also at selling price. So later on, we need to change that back to costs. So here is the diagram to explain what are we going to do in the statements in order to work out the value of inventory as at 31st March 1997. Okay, so next, if you look at point number 2, we are given this 20% markup on cost. That means we can use this markup to link selling price together with costs. We have this formula and saying that selling price is equal to 1.2 times the costs. So we are going to use this formula, all right, to convert selling price back to costs. Okay, so point number 3 here, we have goods sent to customers in the period between January to March, so amounting to 48,000 had not yet been invoiced. So the first thing is you have to think about what is meaning of goods sent to customer. So if you look at this picture, actually goods sent to customer, which is saying as sales. So what happened after sales? After sales, we will have less inventory. So therefore, in my statement here, I have to less, if we start from this figure, so which is point number 3. So we have this goods sent to customers, and that is related to point number 3 according to the question. And however, since this actually means sales and the figure is 48,000, and which is the selling price, so therefore I need to convert this selling price, right, divided by 1.2 to change that back to costs. Okay, so next we come to point number 4. So we have this goods costing 1,000 included in the stock valuation, which is same as inventory valuation at this date, was found to be worthless on 31st March 1997. So that means included in this figure, all right, in this figure, we have something inventory which is worth nothing. Therefore, we have to minus this 1,000 from this figure. Okay, otherwise we will have inventory being overstated because we can't sell any inventory for this part of inventory to the customer. So that this is the adjustment for point number 4. So we have this goods being worthless, and which is related to point 4. And since this is 1,000 is already at costs, therefore I simply put 1,000 here. We don't need to convert that back to cost because it is already at costs. Okay, so point number 5. The stock valuation of 31st December 1996 included 750 stationary stock. So what is the meaning of stationary stock? Stationary stock means we are going to use this inventory, all right, instead of resell it. So therefore, we have to exclude this 750 from the value of inventory here, because the definition for inventory means the purpose is for resale, however, not for used. So here, the adjustment for this stationary stock should be deducted from the value, okay, being included in this date. And then also another 1,600 office equipment, again, should not be counted as inventory, so that here we have two figures need to be excluded or to be eliminated in the statements being included in this figure. So I need to minus, all right, which is stationary stock, which is in point 5, and that is 750. And also I have to exclude office equipment, right, which is 1,600 in my statement. Okay, so point number 6, goods invoiced to customer. So we already have the similar things before. So actually this means sales, and after sales we have less inventory. So therefore we have to minus this goods invoiced to customer. So that is goods invoiced to customers, and this is point 6. So why we send invoice to customers? Because this is sales, and then the amount is 66,000, which is at selling price. And how do we convert selling price into costs? So divided by 1.2. Okay, so let me use my calculator. So that would be 66,000 divided by 1.2 to change it back to costs. So 55,000. Okay, like that. Okay, so point number 7. One of the stock sheets of 31st December 1996 had been over-added by 1,104. That means the figure included here is over-added, which is too large. Okay, to adjust it, we need to minus because it is too large. So here I put this stock sheet or inventory sheet if you like, okay? So being over added, and which is 0.7. Okay, since it is already at costs, so I just put 1,104. Okay, next, point number 8. Goods purchased in the quarter, all right, amounted to 84,226 had been received and recorded. So that means during these 3 years, we have goods purchased. So what happened after goods purchased? We have more inventory. That means if we start from this value, we add this goods purchased. Alright, and this is point number 8. And since this is already at cost, I don't need to change. So I put 84,226 here for point number 8. Okay, so next, point number 9. During the 3 months, goods returned to supplier. So this is opposite to purchases, so that will be returns outward. So what happened after returns outward? So this is goods returned to supplier, means returns outwards. We have less inventory, so therefore I have to minus here in my statements, and which is goods returned to supplier. Okay, so that is related to number 9. Okay, so 734 because it is already at costs. All right, and also I have another sentence here. Goods returned by customer. Okay, so which is same as returns invoice. So what happened after return invoice? We have more inventory. Okay, so therefore I'm going to add in my statement here, and this is goods returned by customer, and point number 9. And since this is the selling price, and then we have inventory always recorded at costs. So how do we convert that? So 876 divided by 1.2 to change that back to costs. Okay, so my calculator is here. Okay, so 876 divided by 1.2 to change that back to cost, so 730. Okay, so next we come to point number 10. You can highlight this point because it is very special in this question and also new to us. Okay, so here is, we have goods sent to the customer on a sale or return basis. Okay, so since this is a very special thing, so here I have the detailed analysis for you. It's all right. So the heading is goods sent on sale or return basis to customer. Okay, so here is the situation, for example. Okay, so we are here. We have a bookmark here. Okay, and our company made this bookmark, and then we are going to sell this very cute bookmark to Lock On, and Lock On make sales for our company. So therefore, we send this bookmark to Lock On. So what do you think after we send this bookmark to Lock On? Will bookmark count this as sales? Of course, no, not. Okay. All right, so the first thing after we send this bookmark to Lock On, so we have no sales yet. Okay, so when would that be sales? Only when customer, they shop at bookmark, okay, and it will be counted as sales. All right, and then what do we earn? We earn commission from Lock On after Lock On making sales for our company. All right, okay, so since we don't make any sales yet after we send the bookmark to Lock On, for example, and Lock On is our customer, we have no sales. So if we have no sales, that means so the customers will not be our debtors yet. So customer not yet debtor of our firm. Okay, and then what happened to this bookmark, which is our inventory? So at the financial year end, where is it? It is still in Lock On, for example. But however, what about the ownership? The ownership belongs to our business. So therefore, even though it is not in our warehouse, however, on the shelf in logon, we have to include this bookmark in our closing inventory. Okay, so the adjustments saying that, so this bookmark should be included, so it should be included in our closing inventory. Okay, so it means the goods, and the goods in our example, which is the bookmark. All right, so do you understand the idea? So therefore we have these three situations. Whenever we have goods sent on sale return basis to the customer, we don't count that as sales, and then the customer owe us no money yet, and then we have to include this this inventory as part of our closing inventory because we still owe this bookmark. All right, okay. Therefore, if you look at this, point number 10, saying that this transaction had been recorded as sales. Of course, this is not true. We should not count that as sales yet. That means sales being overstated. Okay, so what should be the adjustments for sales? For sales, we have less inventory, so that we have the minus for sales, but now we need to do the opposite, so we have to cancel the sales being included. So I have to add back this about goods sent on sale or return basis to customer. Okay, and this is point 10, and how much is that? The figure and the amount is 840 at selling price. So here is 840 at selling price. I need to convert that into cost, so divided by 1.2, so that will be 840. So 840, okay, divided by 1.2. Okay, so which is 700 here. Okay, so next we come to the final point here, the last point. So we have this goods costing 900 were damaged, and it would cost 300 to restore them to a saleable condition. So to explain these points, okay, so I need to draw a picture and explain step by step to you. Okay, here is the explanation. Now, related to point number, this is 11, right? So, okay, let's say case 1 again. We make this, okay, this bookmark is our inventory, and let's say the cost for making this bookmark is $10, and then of course to earn money, so this is the selling price, we mark up, and then we charge $15. All right, so what do you think about closing inventory in the income statement? So how much should be the value of one bookmark, for example? It should be 10 or 15. What do you think? So inventory in the income statement to calculate cost of goods sold must be valued at cost, so that I put 10 here. Okay. And also closing inventory means this is the inventory not yet sold to the customer, so that it will be also in the statement of financial position, which is the balance sheets, as current assets. And what do you think about closing inventory? Okay, it is also should be recorded at costs instead of the selling price. So therefore we have this conclusion and saying that about the valuation of inventory. Okay, so let me change this case 2, and we will look at case 2 later. Okay, so we have this sentence about inventory saying that inventory should be valued at lower of costs or NRV. Okay, so in the accounting standards, and now I need to explain to you step by step. Okay, all right, so inventory should be valued at costs or NRV, so we always choose the lower one because of prudence concepts. Okay, and prudence concept saying that, okay, we should not overstate the good things, such as we should not overstate the value of net profits, right? And the value of assets. And also, we should not understate, no D, okay, understate the value of bad things, for example, expenses, yes, and liabilities, right? So in order to protect the users of financial statements. Okay, so therefore, whenever we have costs or NRV, and now I need to explain what is the meaning of NRV. NRV means the expected selling price or estimated selling price. Okay, and here in this situation, so how much is NRV? And NRV stands for net realizable value. So, and then in this situation, we can say that the selling price here is same as net realizable value, which is NRV. Okay, the estimated selling price, okay, which is 15. And because of prudence concept, since we have the closing inventory not yet sold to the customer, we should not record, okay, the gain, because we haven't sold it, right? We should not record the gain, which is $5, so that we should choose a lower one, which is either 10 and 15, which is the lower one. So here, which one is lower? 10 is lower, so we put 10 here because of prudence concept. So therefore, we have this sentence to record value of inventory. Okay, so this is situation 1. Okay, and case 2. Okay, this is case 1, right? Okay, now case 2. Okay, so the costs is 10. All right. Okay, and look at the bookmark. So what happened if the bookmark is a little bit damaged here? Let's say here, damaged, no good. So therefore, we must lower our selling price. Okay, so here is selling price. Okay, lower the selling price in order to make it sales, is that right? Okay, and now we costs, but however, before we sell it to customer, we have to do some repair, and then we need to spend some money to spend the repair in order to make it sell to the customer. And let's say the NRV is $8. Okay, and this is just example, right? Okay, and then this is because of the estimated selling price, and then which is $15. And then what happened if we need to spend $7 to do the repairs, and then we sell at $15? Okay, and now we come to this selling price in this situation, which is also the net realizable value, which is $8. Okay, so after the explanation, we go back to point number 11 here, so which is goods costing 900 were damaged, and it would cost 300 to restore them to a sellable condition. Okay, so therefore here we have costs, which is 900,000, and then we need to compare cost with NRV, and our NRV stands for net realizable value. And how do we do that? So this is the cost times 1.2, so therefore this is the normal selling price or the estimated selling price. However, we must do some repair. If you don't spend money on repair, we can't sell it at all, so this is minus the estimated costs in order to do repair. Okay, and this is the definition of net realizable value. Okay, again, according to prudence concepts. So here, prudence concepts, right? Okay, again, let me repeat the sentence. So inventory should be valued at costs, should be valued at, I missed out this lower, important, lower of costs or net realizable value. Okay, so we choose a lower one. because of prudence concept. Okay, so which one is lower? So cost is 900, and how much is net realizable value? Okay, so let me use my calculator. So which is 900. Okay, 900 costs. Change that back to selling price, so times 1.2. Okay, however, we need to spend 100 for repair, so 980. Oh, so this one is not, okay, I think I may have careless mistake. Let me check again. Oh, yes. So it would cost 300 to restore them back to a saleable condition. So this is not 100, it should be 300. So I make careless mistake. So here is 300 instead of 100. So no, that's wrong. So again, 900 times 1.2 and then minus 300. Yes, so this is 780. Okay, so therefore you can see which one is lower. So NRV 780 is lower than 900. So therefore we need this double entry to write back inventory. Okay, back, right back. Okay, inventory, right back inventory to net realizable value by, okay, by the change, which is 900. What is the change? 900 minus 780, so that is 120. And the related double entry would be, okay, we suffer because we can't earn money from selling that, so debit profit and loss, and credit inventory by the difference, which is 120, 120, and this is the adjustment. Anyway, we have to decrease minus inventory by 120. So here is my statements. Here minus, okay, 120, and which is inventory written down to net realizable value, and this is the last point. Okay, point number 11, and the step will be 900, which is the costs, and then minus NRV 900 times 1.2 and spend 300, right, spend 300 on repair. Okay, so this is the step to show adjustments related to the last point, which is 120. All right, because of prudence concept. Okay, so the closing inventory as at this date after all adjustments should be 38,021. Okay, so this is a statement showing how do we update the value of inventory at financial year end. And then we have these two special points. One is goods sent on sale return basis, and one is inventory written down to net realizable value because of prudence concept. Okay, and here the final two last points, point number 10 and point number, this is 10, this is 11, okay, being the most special and the important points in this question. All right, so thank you for watching my video. I'll see you next time. Bye bye.